everyone for joining us this morning. We'll go ahead and get started with the presentation. You are at the public workshop for the California Air Resources Board implementation of Senate Bill 253, the Climate Corporate Data Accountability Act. Today's presentation will share updated regulatory concepts for Scope 1, 2, and 3 reporting and assurance as directed by SB 253. So to begin, I'll share a few logistical notes and reminders. This workshop is being held fully remotely via Zoom. It's being recorded, and we'll post the recording on our webpage as with past workshops. These presentation slides are currently available for download at www.arb.ca.gov/climate-disclosure/workshops. After the staff presentation, we'll hold a public comment period when you'll be able to raise your hand in Zoom to speak. To make sure we maximize our ability to hear from commenters, we'll be adhering to a 2-minute comment time limit. There are other opportunities to connect with us beyond today's workshop, including at listening sessions over the coming weeks. At the end of the presentation, we'll share more details about next steps. And as always, feel free to reach out to Climate Disclosure at arb.ca.gov. Today is focused on updates to the regulatory proposal under development, which will establish reporting and assurance requirements starting in 2027. First, we'll share some background on California's corporate greenhouse gas emissions disclosure laws. Then we'll share some brief updates on the initial regulation heard earlier this year by the board, which established fee applicability and reporting requirements for 2026. We'll focus on 2027 reporting concepts, which are being developed in this separate subsequent regulation. During the presentation, our team will share initial drafts of regulatory language that we intend to include in a staff proposal to be published later this fall. We'll also share some updates on our economic analysis and proposed amendments to the initial regulation exemptions. Thank you to all public commenters throughout the process thus far. Your input has shaped the ideas we'll be sharing today. And after the staff presentation, we'll close by hearing comments from the public and sharing information about our next steps. CARB has regulated greenhouse gas emissions in California since 2006, including overseeing key programs like mandatory greenhouse gas reporting, Cap and Invest, and the Low Carbon Fuel Standard. SB 253, as amended by SB 219, is codified in Health and Safety Code, Section 38532. Its goal is to improve transparency on corporate climate-related emissions to inform consumers, investors, and other stakeholders in California. SB 253 directs CARB to adopt rules requiring large corporations, those with over $1 billion in annual revenue, doing business in California, to report their Scope 1, Scope 2, and Scope 3 emissions on an annual basis, and phases in third-party assurance of these disclosures. Statute directly cites the Greenhouse Gas Protocol, or GHGP, as the accounting standard that reporting entities should conform to in making climate disclosures. GHGP is a globally recognized framework for measuring and reporting greenhouse gas emissions. It defines Scope 1, Scope 2, and Scope 3 emissions and describes standardized methods for corporate carbon accounting. Using the GHGP supports interoperability with other disclosure programs, such as the International Financial Reporting Standards for Sustainability and the EU Corporate Sustainability Reporting Directive, and this reduces reporting burdens. Staff referenced 3 core documents from the Greenhouse Gas Protocol: the Corporate Accounting and Reporting Standard, the Scope 2 Guidance, and the Scope 3 Value Chain Accounting and Reporting Standard. Before turning to more details on our regulatory proposals, I'll share a few updates and broader context about our approach. The board passed the initial regulation implementing Senate Bill 253 as amended by Senate Bill 219 in February 2026. This initial regulation established foundational requirements for definitions and applicability, fee assessments, and the first-year GHG emissions reporting requirements. CARB chose to withdraw the package from the Office of Administrative Law to provide more advance notice to reporting entities by establishing a new reporting deadline of November 10, 2026, and to clarify certain requirements of the regulation. Staff will propose these changes and post them for a 15-day public comment period. For more information, please review the announcement that was sent on June 24, 2026, that's linked on this slide. And as a reminder, CARB's enforcement notice continues to provide flexibility for companies reporting in 2026. Staff will release additional information on the 2026 reporting process in advance of the November 10th reporting deadline. Please note that this process information pertains to 2026 reporting only. The ongoing reporting process will be revised and formalized under the 2027 regulation development process. Staff are preparing a voluntary online intake form that regulated entities may use to streamline their submissions and provide fee information to CARB. Staff will also post a guidance document and instructional video for using the intake form. The remainder of the workshop today does not focus on changes to the initial regulation, but is focused instead on the subsequent rulemaking, which defines reporting requirements in 2027 and beyond. Now we'll turn to our updated concepts for the SB 253 rulemaking. Today's presentation serves to preview concepts that staff are developing and intend to publish in a proposed regulation this fall. This proposal will include a staff report, economic analysis, and a full draft of proposed regulatory text. It will be available for a 45-day public comment period before it's considered by the board at a public meeting. The board will also hear verbal comments on the staff proposal at that public meeting. Today we'll share some key concepts that we intend to include in this full proposal and seed some questions for discussion. We hope today's information can also aid reporting entities in their preparation for the addition of Scope 3 reporting requirements next year. So we'll share some more about our underlying approach to this regulatory development process. This approach is rooted in direction from SB 253, which is part of a broader international policy evolution toward mandatory rather than voluntary corporate climate disclosures. California is one of many jurisdictions implementing climate disclosure policies. These jurisdictions collectively represent more than 2/3 of the world's population and around 60% of GDP. Statute directs reporting entities to make disclosures in conformance with the Greenhouse Gas Protocol, a leading global framework for carbon accounting. The ideas we present today are designed to align with the requirements of the GHGP wherever possible, adding clarifications where needed for California's mandatory reporting program. Law also requires that these reported emissions be verified through assurance engagements and released publicly to enhance access and transparency, not just for investors, but for consumers and other stakeholders. We've heard ample feedback around the importance of alignment and interoperability with other jurisdictions' reporting programs, and want to reassure reporters that we are promoting interoperability to the greatest extent possible. We do not want to reinvent the wheel with this program and would like to leverage that experience that many reporting entities already have with voluntary or mandatory climate disclosures. We will appreciate your suggestions and recommendations around the resources and reporting intake design that can best support this alignment. To help stakeholders track our proposed requirements, we've categorized the regulatory concepts into a few main buckets. In most cases, we propose language that will implement the required reporting approach documented in the Greenhouse Gas Protocol. In some cases, we also propose language that implements GHGP recommendations, such as the Scope 3 value chain standard, where it's necessary to achieve SB 253's statutory goals. And in a few instances, we also include some proposed regulatory provisions that don't map directly to portions of the GHG protocol, but are responsive to statutory direction and provide needed clarity for the California regulatory context. You'll see these labels on the following slides, as well as citations to the underlying GHGP documents that we would incorporate in our regulation for your easy reference. Now I'll hand things off to my colleague, Dr. Sandra Bueno, to walk through some of our proposed general reporting requirements.
Thank you, Emma. Our general reporting requirements are intended to implement the protocol's 5 foundational principles of relevance, completeness, consistency, transparency, and accuracy. This general section applies to reporting across all 3 scopes, and we also offer scope-specific reporting requirements in the sections that follow. The right-hand side box shows the key topics covered by general requirements, from citing standards to data exclusions, recalculation requirements, and more. I will walk through each of these concept proposals on the next few slides. Overall, we are seeking your feedback on whether these requirements offer adequate clarity for reporters, and if there are any aspects of the greenhouse gas protocol that should be further clarified in our reporting requirements. First, our proposed requirements indicate that gross emissions from each scope shall be disclosed in accordance with their section-specific requirements. Scope 1 includes direct emissions from sources that are owned or controlled by a company, such as on-site fuel combustion and company-owned vehicles. Scope 2 includes indirect emissions from purchased energy, such as electricity, steam, heating, or cooling. Scope 3 includes all other indirect emissions across the value chain that are not included in Scope 2, such as transportation, purchased goods and services, and use of salt products. Our proposal directs reporting entities to reference their Greenhouse Gas Protocol Corporate Standard, Scope 2 guidance, and Scope 3 standard, unless superseded by other proposed requirements in the proposed regulation. You can find those links to the underlying frameworks and guidance as published by the Greenhouse Gas Protocol below, and specific citations where relevant are included on the following slides. The corporate standard requires that reporting entities disclose organizational boundaries and consolidation approach, as well as methodologies used to calculate or measure emissions, providing a reference or link to any calculation tools used. This proposed subsection aligns with this Greenhouse Gas Protocol requirement. Staff proposed that reporting entities must disclose specific attributes of their quantification methods, including the consolidation approach for organizational boundaries, the global warming potential values and assessment report vintage used, emission factor sources and features, and the quantification method used. This disclosure should also include any process-specific tools or models. This method disclosure requirement applies to all greenhouse gas disclosed under Scope 1, 2, and the Greenhouse Gas Protocol recommends disclosure of measurement uncertainty, where possible, to support transparency and verifiability. CARB proposes adopting this recommendation with a flexible requirement for reporting entities to disclose either quantitative or qualitative uncertainty measures, or explain why it is infeasible to measure uncertainty. Staff are proposing that reporting entities be required to assess the uncertainty associated with the quantification methodologies used to calculate emissions, including underlying data sources, assumptions, and models, and report confidence intervals with data points where applicable. Where quantitative estimation of uncertainty is not feasible or would impose unreasonable burden or cost, staff are proposing that reporting entities shall provide an explanation and conduct a qualitative assessment of uncertainty. We hope this reporting will also help improve the state of greenhouse gas quantification practice over time by identifying reporting areas that would benefit from stronger measurement tools. In alignment with the California's mandatory greenhouse gas reporting regulation, reporters are required to disclose any missing data and substitutions for reporting in 2027 and beyond. Staff propose that reporting entities must identify any missing data or information needed to calculate emissions and explain what substitute data source or estimation method was used instead. The reporting entity must also explain why that approach was selected and identify any assumptions used to calculate the emissions. Mandatory reporting regulation data may be provided with B253 disclosures, so this provision is included for consistency across the programs. This section would require reporting companies to separately report carbon dioxide emissions from biomass and other biological sources, rather than including them in their Scope 1, 2, and 3 totals. Staff are proposing that methane and nitrous oxide from combustion should be included within the relevant scope totals, and that upstream life cycle greenhouse gas emissions from biomethane production, processing, and transportation should be reported in the relevant scope 3 categories. This approach is in alignment with the Greenhouse Gas Protocol. To allow for maximum flexibility and alignment with other California programs, such as the Low Carbon Fuel Standard and international guidance, such as Land Sector and Removals Guidance from the Greenhouse Gas Protocol, CARB staff intend to propose that reporting entities may use and disclose the method they deem most appropriate to measuring their biogenic emissions. These disclosures are subject to independent assurance requirements. In alignment with Greenhouse Gas Protocol requirements, staff intend to propose that reporting entities may include any voluntary investments or management activities, such as land management practices resulting in biological greenhouse gas sequestration, as separate disclosures. Voluntary reductions or removals must be reported separately from gross Scope 1, 2, and Scope 3 emissions. As expressed on the last few slides, CARB will require documentation of methods used to quantify greenhouse gases, but will not require the use of any particular approach, allowing reporting entities to determine the approach that is most accurate and feasible based on their situation. At the same time, the Greenhouse Gas Protocol recommends that reporting entities prioritize the use of primary data where available, as it tends to result in more accurate quantification. CARB staff also received public feedback noting that methane emissions in particular are often underestimated when reporting relies on emissions factors rather than direct measurements. CARB requests public feedback on any additional guidance that should be provided for methane emissions or other emission sources to ensure emissions quantification reflects the most scientifically sound approach. Here, we have included some guidance questions. Are there cases when CARB should encourage or require the prioritization of specific emission factors or quantification methods? If so, what approach could support scientific best practices while offering adequate flexibility when higher quality data are limited or unavailable? Are there sector or source-specific quantification methodologies or standards CARB should consider recommending in follow-up guidance documents? The Greenhouse Gas Protocol describes approaches to permissible data exclusions in the corporate standard, which is summarized in staff's proposed regulatory provisions shown on this slide. Staff proposed that regulated entities may exclude data on emissions in instances where the omission, misstatement, or obscuring could not be reasonably expected to influence the decisions, assessment, or understanding of users of the disclosure regarding the reporting entity's greenhouse gas emissions inventory, climate-related risks, opportunities, or impacts. Reporting entities would be required to consider and apply the Greenhouse Gas Protocol's foundation principles of relevance, completeness, consistency, transparency, and accuracy in making these determinations, and disclose, to the extent feasible, the sources that were accordingly excluded from their report. Staff requests feedback on the proposed data exclusion factors, including: are the proposed factors appropriate and sufficient for considering acceptable exclusions from greenhouse gas emission inventories? What further direction may be needed for reporting entities to consider data exclusions in a consistent and comparable way? And does the proposed approach balance reporting burden with the objective of providing complete and decision-useful emissions information? In alignment with the Greenhouse Gas Protocol, reporting entities must disclose changes to their greenhouse gas quantification or accounting methods, explain why the changes were made, and determine whether prior emissions must be recalculated. Reporting entities must evaluate whether cumulative changes in their corporate structure, accounting methods, data sources, or emission factors would change their base year emissions by more than 5%. If such a change occurs, the companies must recalculate affected prior year emissions and disclose the updated data and the reasons for the recalculation in their next annual greenhouse gas report. CARB staff have proposed a 5% change threshold to provide clarity and standardize when prior year recalculation will be required. Reporting entities must disclose their Scope 1, Scope 2, and Scope 3 greenhouse gas emissions for the preceding fiscal year in an annual report submitted to CARB by the reporting deadline, proposed here to be November 10, in alignment with the planned deferral for 2026. Staff welcome feedback on this reporting deadline for 2027 and beyond. Staff have heard feedback that reporting requirements may not match all information companies may wish to disclose related to their operations and climate impacts. Reporting entities may voluntarily submit supplemental qualitative or quantitative information to supplement the required disclosures. This concludes our presentation of updated concepts for general reporting requirements. Now, I will turn things over to Lin Xiao to share updates on our scope-specific reporting and assurance requirements.
In alignment with the Greenhouse Gas Protocol standard, staff intend to propose that reporting entities Scope 2 emissions by source type, such as electricity, steam, heating, and cooling. Stating that both total emissions in carbon dioxide equivalents and greenhouse gases that make up those emissions. Emissions must also be calculated and reported using both market-based and location-based methods, and any missing emission factors must be documented in accordance with the missing data procedures. The Greenhouse Gas Protocol Scope 2 guidance is being updated by the Greenhouse Gas Protocol. As the updated guidance has still not yet been finalized, staff are not proposing to require alignment with the updated Scope 2 guidance at this time and will instead incorporate by reference the 2015 version that is currently in effect. Staff has heard feedback expressing concern with the lack of readiness of mature Scope 3 accounting methodologies for all sectors and the potential complexities and costs associated with reporting all 15 categories. In March, staff presented 3 options for Scope 3 reporting requirements. 1, broad applicability, 2, sectoral phase-in, and 3, category phase-in. Based on staff's analysis of public comment and existing reporting protocols, staff are proposing option 3, which is a category for Scope 3 reporting. This would mean reporting on the 5 most commonly reported categories starting in 2027, which are purchased goods and services, fuel and energy-related activities generated during operations, business travel, commuting. Many comments on phasing in by categories requested additional flexibility for excluding emissions that are on a company's inventory. In response, we have incorporated a provision that is aligned with the Greenhouse Gas Protocol and applies to these initial 5 required Scope 3 categories. Based on public feedback, we also understand that not all companies are at the same level of readiness for climate disclosure. In response, staff are proposing to accept voluntary reporting on the other 10 Scope 3 categories so that companies that are prepared for more complete scope have a pathway to report. In other words, the proposal takes a measured approach to phase in Scope 3 emission reporting for companies with less experience with climate disclosures, while allowing companies with robust Scope 3 reporting programs already in place to continue using their existing reporting practices and to lead the way. As the program is implemented, the state of reporting practices will evolve through increased transparency and opportunities for peer learning. And CARB hopes our program can contribute to a more robust field of practice. Once more, here are the 5 Scope 3 categories staff are proposing to require starting in 2027. Category 1, purchased goods and services. 3, fuel and energy-related activities. Waste generated in operations. Category 6, business travel. And Category 7, employee commuting. These categories were selected for this initial concept as they are widely applicable to most sectors and have relatively well-developed calculation methods and often rely on data that companies are already collecting for other reporting or for operational purposes. Staff propose that reporting entities shall follow guidance from the Scope 3 standard for calculating emissions within these categories. As mentioned earlier, to maintain alignment with the Greenhouse Gas Protocol, staff propose that reporting entities may voluntarily disclose emissions from the other 10 Scope 3 categories, which are Category 2, capital goods, Category 4, upstream transportation and distribution, Category 8, upstream leased assets, Category 9, downstream transportation and distribution, Category 10, processing of sold products, Category 11, use of sold products, Category 12, end-of-life treatment of sold products, Category 13, downstream lease assets, Category 14, franchises, and Category 15 investments as identified in the Scope 3 standard. For any voluntarily reported Scope 3 categories, reporting entities should follow guidance from the Scope 3 standard for calculating emissions within these categories. For each required Scope 3 emission category, staff are proposing that entities disclose the following information, which is in line with the Greenhouse Gas Protocol requirements. First, the name and number of the category as identified in the Scope 3 standard, and a description of the activities included in the emissions inventory. Second, quantification and accounting methods and the data types used. Third, the sum of Scope 3 greenhouse gas emissions generated during the reporting period, expressed in metric tons of CO2 equivalents. Fourth, explanation for any emissions excluded from the Scope 3 category. And lastly, the percent of emissions calculated using primary data. Now I'll move on and share some updates on the staff proposed concepts for data assurance. While the Greenhouse Gas Protocol recommends assurance engagements, it does not require them. However, SB 253 has a clear assurance requirement phase-in, which these regulatory provisions are intended to implement. Staff are proposing that beginning with reports submitted in 2027, reporting entities must obtain independent third-party limited assurance of their disclosed Scope 1 and 2 emissions, including separately reported biogenic CO2 emissions. A reasonable assurance engagement may be used in place of that limited assurance. CARB received numerous public comments affirming the proposed list of acceptable assurance standards presented at the last workshop. So staff have retained this list in its proposed regulatory language. This proposed regulatory concept for assurance requirements accepts multiple assurance standards that feature different accountability mechanisms. Some rely on individual professional licensure and oversight by state boards of accountancy. Others rely on organizational accreditation and oversight by the national accreditation bodies. And others rely on engagement level requirements and mandatory licensing agreements with the standard setting body. Each network has its own approach to independence, competency, quality management, oversight, and accountability. CARB staff would like feedback on whether these assurance standards produce outcomes that are sufficiently comparable. Would also like to know whether this approach adequately ensures that an engagement performed under any of these recognized standards provides a meaningful and consistent level of confidence in the disclosed emissions data. To provide sufficient clarity for the California regulatory context, CARB staff intend to propose defining assurance reports requirements as shown on the slide. This proposed reporting concept would require the assurance provider to issue and submit a written report that identifies the standard applied, the emissions covered by the engagement, the assurance conclusion, basic contact information, and the date the assurance engagement was completed. Alongside these proposed reporting requirements, we are interested in discussing whether assurance providers should be required to disclose any other services to the reporting entity, such as tax, audit, consulting, or advisory services, as well as whether assurance providers should rotate, and if so, at what intervals. Lastly, we'll cover some remaining updates to the exemptions, as well as our economic analysis. For this, I'll hand things off to my colleague, Dr. Paul Fermo.
Thank you, Lynn. The initial regulation exempted insurance companies from reporting greenhouse gas emissions to CARB in 2026 under Health and Safety Code Section 38532. This exemption was intended to avoid duplication with existing emissions reporting requirements established by the California Department of Insurance, CDI. CARB's December 2024 enforcement notice, which applies to all covered entities in the first reporting year of 2026, provides that companies are not required to create or collect new data solely for first-year regulatory compliance. Under the enforcement notice, companies may rely on information already in their possession or being collected at the time of the notice. The CARB board directed staff to follow up on this topic in Board Resolution 26-1, which directed CARB staff to coordinate with CDI and evaluate and propose future requirements to include insurance companies under the scope of Health and Safety Code Section 38532, provided that they would not otherwise submit that data to the Department of Insurance while minimizing duplication. Under CARB's enforcement notice, in 2026, an insurer not already collecting Scope 1 and 2 data as of 2024 would have no obligation to start doing so, even if they had not been exempt from the first regulation. However, staff have confirmed that there would be reporting gaps between CDI's required submissions and these potential rules starting in 2027, particularly when Scope 3 emissions reporting begins. First, the level of detail in CDI disclosures would likely not satisfy CARB's forthcoming requirements for standardized reporting of Scope 1, 2, and 3 emissions data for 2027 and beyond. Second, CDI disclosures are made in compliance with the National Association of Insurance Commissioners survey based on the Task Force for Climate-Related Financial Disclosure, or TCFD framework. While there are some overlapping provisions, TCFD is a broader framework for reporting on climate-related financial risks and impacts, including elements like a company's governance and strategy, and has fewer detailed requirements for GHG reporting than the Greenhouse Gas Protocol. Therefore, the rationale for exempting insurers would not carry forward into the next phase of the program, especially given that the 2024 enforcement notice will not apply to 2027 emissions reporting. Staff propose allowing insurance entities to report to CARB the greenhouse gas emissions data they are already submitting under CDI's program, plus any additional data needed to meet the reporting requirements established by Health and Safety Code Section 38532. This approach avoids duplicative reporting while capturing the comprehensive data reporting directed in Health and Safety Code Section 38532. Staff received a variety of feedback on cost estimates following the March workshop from potential reporting entities, third-party service providers, and other practitioners. Feedback on CARB's analysis ranged from compliance costs being underestimated to being in line with actual cost or to costs being overestimated. Commenters expressing concern about underestimated costs primarily referenced the cost of Scope 3 emissions accounting and the cost of assurance engagements. Some commenters also noted potential sources of cost overestimation, including rapid technological advances, particularly the use of artificial intelligence to facilitate greenhouse gas accounting and reporting, or comments reflecting the cost savings of high interoperability between CARB's reporting program and other existing frameworks. Some commenters also noted that there are significant benefits from reporting that CARB did not compare against costs, including financial benefits for companies disclosing emissions. Staff recognize that compliance costs will be highly variable across entities and may depend on several factors, including company size, complexity, and sector, existing regulatory requirements to report similar data to other government agencies, existence or rigor of existing systems, in-house expertise, and protocols for voluntary reporting, experience and access to cost-competitive assurance providers, and experience with any subset or full reporting of Scope 3 categories. These variables are reflected in the range of cost estimates from industry and practitioner surveys that have informed economic analyses and other mandatory disclosure programs, including the SEC and the EU CSRD. Staff acknowledge that there may be some uncertainty with relying on these existing cost analyses and surveys from subsets of entities, particularly for staff's unique Scope 3 phase-in option. For entities not currently reporting, there may be uncertainty not captured in existing analyses about how companies are still preparing for mandatory reporting, given the general rollback of federal support for environmental and climate initiatives. Based on stakeholder feedback, staff have reviewed cost analyses from other jurisdictions and industry surveys submitted during the March workshop public comment period. Staff's preliminary economic economic analysis adapted cost estimates from the SEC rulemaking. The range of compliance costs considered by SEC included costs related to the collection and reporting of greenhouse gas emissions data, including investments in the development and maintenance of information systems, staffing, and governance protocols for ongoing reporting. In response to feedback that Scope 3 costs may be underestimated in the SEC analysis, staff uses the upper bound of reporting cost estimates rather than the midpoint value and assumes all costs were ongoing to account for the higher year one initial costs that include investments in reporting systems and staff. Staff also removed the assumption that ongoing assurance costs are lower than initial costs. Staff also assumes that compliance costs are entirely due to CARB's program. This approach likely overestimates real costs since many entities already engage in reporting and assurance of reports for other jurisdictions that are aligned with staff's proposals. Stakeholder feedback also included that in addition to the corporate transparency benefits of more standardized data, studies show that there are also organizational, financial, and environmental benefits of non-financial disclosures, which may include enhanced supply chain management and traceability, increased investment, firm valuation, and other financial benefits for companies, voluntary reductions in corporate greenhouse gas emissions following disclosures. Staff are considering the best available data from public and academic analyses, as well as documented costs provided by stakeholders. As CARB staff analyze the potential impacts of SB 253, we remain open to feedback on specific data and information from stakeholders about potential costs and benefits. What cost changes does your business anticipate from making climate disclosures? Similarly, what are the benefits that you anticipate? Now, as we wrap up the staff presentation, we'll cover some important information about upcoming engagement opportunities and updates from our team in the coming months. In the coming weeks, staff will host listening sessions to hear more from reporting entities and other stakeholders to inform our approach to this reporting program design and implementation. The virtual sessions will not present new information beyond workshops held thus far. Rather, they are offered as an opportunity for participants to share their reporting-related experience, questions, and concerns, and to hear from others in related sectors. We also hope this can be an opportunity for newer reporting entities to connect with more experienced reporters in their sector to exchange best practices. CARB staff also want to hear from potential users of the data around how to maximize transparency and effectiveness of the disclosures for the public, as well as from organizations in the report preparation and assurance sector. We will share discussion questions in advance and will prioritize facilitating active participation from attendees whose experience is aligned with the session topic. The schedule includes 6 sessions, starting on August 5th, and will be posted on our website soon. Please sign up for our email list to receive notification when registration is open. These listening sessions are only the start of implementation-focused engagement, and we look forward to hearing your perspectives. We will now transition to our public comment period. We welcome your questions, comments, and feedback on these proposed program updates. If you have a question or comment, please raise your hand in Zoom or dial #2 if you are calling in. Please note that the 2-minute time limit applies per participant, and you will not be called on again if you raise your hand a second time. The facilitator will inform you when you have been unmuted and may proceed with your comment. I'll now hand things over to Dr. Adam Cooper, who will begin moderating our public comment period.
Thank you, Dr. Furuma. Our first public commenter is Sandra Guzik, followed by Scott Byrne. Sandra, we've activated your mic. Please unmute yourself and begin your comment.
Hi, Sandra. Can you go ahead and try to unmute again? We're not hearing you. Thank you.
All right, we'll now move on to the next public commenter, Scott Byrne, followed by Mark Seknon. Scott, we have activated your microphone. Please unmute yourself and begin your comment.
No comment. Thank you.
All right, thank you. Moving on to Mark Seknon, followed by Jason Fox. Mark, we've activated your microphone. Please unmute yourself and begin your comment.
Great. Thank you. My name is Mark Seckman, and I'm here on behalf of the American Property Casualty Insurance Association. We are the national trade association representing the majority of home, auto, workers' compensation, and commercial insurers. We are here today to speak in continued support of the initial regulations approved by the board in February of this year to exempt insurance companies from the 2026 GHG emissions reporting requirements in order to avoid duplication with the parallel reporting requirements required by the California Department of Insurance as part of the annual NEIC Climate Risk Disclosure Survey. We think this is an appropriate recognition of that fact that insurers are subject to a distinct and comprehensive regulatory framework under CDI already. Further, we appreciate the coordination between CARB staff and CDI staff on these climate-related disclosures with the goal of ensuring alignment while avoiding duplication and maintaining appropriate regulatory justification. Regarding the staff recommendation that beginning in 2027, insurers may submit the same report, the NIC Climate Risk Disclosure Survey, to both CDI and CARB, we would be interested in ensuring the most streamlined means of submission and look forward to engaging in further discussions with both CDI and CARB staff to arrive at the best outcomes for all involved. We are appreciative of the recognition of our existing reporting requirements and a desire to avoid duplicating that with parallel reporting requirements. Thank you for your time and consideration of these comments.
Thank you for your comment. Our next public commenter is Jason Fox, followed by Ted Grozier. Jason, we've activated your microphone. Please unmute yourself and begin your comment.
Hi, Jason Fox with the California Society of Certified Public Accountants. Thank you for these continued workshops and the thoughtful stakeholder engagement. It's been very helpful. We know CARB is balancing a lot of technical and big issues, and I think you're doing a great job with that. With respect to today's workshop, 3 brief comments. So first, on the assurance standards, we appreciate the direction CARB is taking. It aligns with the comments we previously submitted, particularly in recognizing the relationship between the performance standards and minimum qualifications for assurance providers, including quality management, accreditation, and oversight. We have noted that the staff had asked additional questions around the assurance regulations, and we'll consider those in our written response following the workshop. But overall, I think the direction that CARB is going with this is the right direction, and look forward to reviewing the draft regulatory language. Second, on the scope of the assurance engagement, we'd appreciate clarification on whether the assurance is intended to cover all the quantitative Scope 1, Scope 2 emission data, including the biogenic emissions, or whether it also extends to the qualitative information included in the reporting requirements. As regulatory language is developed, that might be an area that needs additional clarification, or at least just additional guidance on. Finally, an item to flag on interoperability. I know it's important for CARB and all the stakeholders to leverage assurance work performed under existing reporting frameworks where appropriate. A question to consider is how that will work in practice when those engagements may cover a broader scope than what California is requiring. It may be necessary to think through the practical mechanisms that support that interoperability, whether there's a California specific supplemental schedule or some other kind of approach that supports providers leveraging existing insurance work while still meeting California's requirements. So thank you for the time and the consideration of our comments. We plan to submit additional written comments that will elaborate on these points and others as we go through the materials. Thank you.
Hi, Jason.
This is Pedro Peterson, the manager of the climate data reporting section. Thank you for your comments. The assurance requirements for scope 1 and 2 emissions apply to the entire submissions for scope 1 and 2, which includes this sort of quantitative pieces that you mentioned and the qualitative, but we welcome your feedback and written comments on this topic. Thank you.
The next public commenter is Ted Grozier, followed by John Schadeller. Ted, we've activated your microphone. Please unmute yourself and begin your comment.
I have, thank you. My name is Ted Grozier. I'm the Chief Sustainability Officer at GoodLab, which is one of the leading software-powered consulting firms helping companies comply with SB 253. My questions are about the proposed Scope 2 reporting of component gases alongside CO2e. First, will this be required for disclosures this year? Second, will this be required for district steam where data is limited? And third, will component gas reporting be required in Scope 1 in 2027 and in future cycles? Thank you very much.
Hi, Ted. Thank you for the questions. For the 2026 reporting, we continue to point to the 2024 enforcement notice, and which said that we are accepting data that was being collected by entities at that time, and so yeah, that continues to be the guidance. The question about district steam that should be disclosed under this. If you have any suggestions for how to sort of best do that accounting and clarify anything in the Greenhouse Gas Protocol Scope 2 guidance, we really appreciate it. Thank you.
The next public commenter is John Schadeller, followed by Stephen Rothstein. John, I have activated your microphone. Please unmute yourself and begin your comment.
Thank you very much. This is John Scheidler from Omnex Future Past. I'm the managing director. And I really appreciate the workshops that CARB is preparing and administering here because it provides a lot of clarity to the regulated community and to assurance providers like ourselves. The one thing that I found missing on the slide that described what the assurance requirements would include is some kind of description of the basis for conclusions. And in the ISO 14064 standard, which is one of the selected approved criteria for assurance provision, it's expressed this way: a description of the evidence gathering procedures used to assess the greenhouse gas statement. We will submit formal written comments on this, but generally speaking, we think that it's very important that assurance providers describe the activities that they performed, even under limited assurance. Not all assurance providers are created equal, and this will give the people who rely on these assurance statements some basis for concluding whether or not the assurance activities were robust and complete. And I'll just also mention on the question of auditor rotation, I think that is important. There's always a familiarity bias that can creep in. And so I think CARB should set rotation requirements for assurance providers. Thanks very much.
Thank you for your comment. We look forward to reading your written comment. Our next public commenter is Stephen Rothstein, followed by Michelle S. Stephen, we've activated your microphone. Please unmute yourself and begin your comment.
Great. Can you hear me okay?
Yes.
Great. Stephen Rothstein, Chief Program Officer at Ceres. First, thank you to you and everyone at CARB for all the hard work not just today, but leading up to this. We really appreciate and the engagement of the public. Second is appreciate the North Star focus on interoperability throughout that element. And third is the addition of the insurance element. The insurance industry we think is great, and in line with the earlier comment to think about the interoperability of that. So there are lots of good things. Next is, I don't think it'll surprise anyone at CARB that we would rather you have full implementation of Scope 3, not the way you've done it. But if that's the way you're going to do it, we think it is absolutely critical to set dates for the next implementation date. That when you talk to companies, when you talk to investors, one thing they want is to be able to plan. So if they knew, for example, that they would have to do it in 2028, for example, that gives them planning opportunity. Just to put this in context, in the 90 plus years of the Securities and Exchange Commission, the topic that got the most investors' comments were climate disclosure, and they were over 98% supportive of going forward. So large institutional investors, companies, they want certainty, even if they may or may not like one element of that. So we think it's important for companies, it's important for investors, and obviously California is going through its own change in the November election. So while we would have rather and hope that you would reconsider Scope 3 to fully implement it now, if not, we hope that you will set a date, hopefully 2028, as part of the final rule. We'll be submitting more detailed comments. Thank you again for everything you're doing.
Thank you for your comment. Our next public commenter is Michelle S., followed by Daniela Arias. Michelle, we've activated your microphone. Please unmute yourself and begin your comment.
Great, thank you. It took me a minute to find the unmute. This is Michelle Savage. Sorry, I had Michelle S. Michelle Savage from XBRL US. We are a nonprofit data standards organization. We advocate for the use of data standards, specifically the XBRL standard, where we think it will improve efficiencies and enable interoperability. I just want to point out that the data that you are required to be collected to satisfy SB 253 is very complex. It's highly dimensional data. And as we have said in the past, we encourage CARB to require covered entities to prepare this data in alignment with a detailed taxonomy, which is essentially a digital collection of terms that concretely defines the meaning of a reported value. The appropriate taxonomy that can be used has already been developed. It is open and freely available for use from the IFRS Foundation. They've developed a taxonomy called the International Sustainability Standards Board taxonomy, and it also aligns with the Greenhouse Gas Protocol. This taxonomy contains terms that represent Scope 1, 2, and 3 greenhouse gas emissions. It also describes the relationships between data points that may appear on the same report. Data that is prepared in structured standardized format eliminates ambiguity and ensures that both covered entities as well as data users are speaking the same language. And it renders the data prepared in machine-readable format, which is more timely, it's more efficient, it's interoperable, and it's also optimized for use with artificial intelligence platforms. CARB can even add to the ISSB taxonomy to include additional terms that are specific to SB 253 reporting needs, for example, text blocks of supplemental information and other facts that need to be reported. So I know that this rulemaking session does not include formatting, but we strongly encourage you to consider that in the next phase. Thank you very much.
Thank you for your comment. Our next public commenter is Daniela Arias, followed by Samantha Weinberg. Daniela, we've activated your microphone. Please unmute yourself and begin your comment.
Great, thank you so much. Hi, everybody. This is Daniela Arias with Crow LLP. I help lead our ESG sustainability services practice. Crow is a CPA consulting advisory firm. We work with companies on greenhouse gas accounting, reporting, controls, assurance readiness, and then of course assurance. And my question really is about the timing of these rules regulations relative to the GHG protocol updates. So since CARB's guidance is going to be largely based off of the protocol, and we know that the corporate Scope 2, Scope 3 standards are all in process of being revised in one way or another. Some of those changes might be finalized around 2027. Has CARB thought about that? How is CARB thinking about that for SB 253 reporting? Are companies going to be expected to automatically move to new versions? Will CARB first determine which version applies and maybe provide a transition period? Or will CARB's guidance ultimately end up diverging from the protocol over time? So in general, I think my comment is I would encourage CARB to address this directly in the guidance. I think it will be something that will become sort of an important subject and topic down the line. So things like which version would apply, whether early adoption would be allowed, how companies would treat changes in reported emissions or disclosure requirements that might result from a new standard rather from a new than from a new error or from an error or omission. So highly recommend including that as part of the overall guidance development. Thank you very much.
Hi, thank you, Daniela. Thank you for your question. So CARB staff is tracking those conversations about updates to the greenhouse gas protocol. And however, we have certain clarity standards that we have to meet when we undertake our regulatory processes that we are not able to sort of have regulations that are dynamic in that way that will sort of, incorporate future changes to a particular standard. So we are sort of memorializing the sort of the version of the standard that is in place when we adopt our regulation, and so future updates would not sort of automatically trigger any changes to the reporting requirements, as the greenhouse gas protocol evolves. So thanks again for your question.
Our next public commenter is Samantha Weinberg, followed by Surya Ramakrishnan. Samantha, we've activated your microphone. Please unmute yourself and begin your comment.
Great. Thank you all so much. Thank you, CARB, as always, for a really informative workshop. My name is Samantha Weinberg, and I'm a manager at Agendi, which is a sustainability consulting firm that supports companies with California regulatory compliance. I've got a couple of questions. The first is kind of related to the question that Daniela just asked, but more specifically on biogenic emissions. Latest land sector removals guidance does not always include biogenic CO2 outside of the inventory. So does CARB plan to follow this guidance or always expect biogenic CO2 outside of the inventory in the way it's being recommended in the current draft regulatory language? And the second question is about the deadline. So for 2026 reporting, CARB provided clarification on which fiscal year was most appropriate for companies to use in their reporting. And I'm curious if they're planning on doing that for 2027 and beyond, using the proposed deadline where they would share based on the date of your fiscal year end, this is the most appropriate reporting year to use for filing. As I believe a lot of organizations found that really helpful and would likely appreciate that for future reporting guidance as well. Thank you.
Hi, Samantha. This is Jordan Armalingam. Thank you for your comments and questions. To your first one about biogenic emissions, so use of the land sector and removals standard or protocol is voluntary, and what we were trying to convey in the slides is that you could essentially pick the approach that you will use for accounting for those emissions, for those biogenic emissions, but then just be really clear in your report with CARB as to what standard or protocol you're following there. But as far as biogenic emissions go, we are proposing at this point that those emissions would always be separate from the scope 1, 2, and 3 buckets, essentially, for a company's ledger. And to your second question, yes, I think it would be helpful to have the similar fiscal year delineation that we did for the initial regulation, and that's something that we're looking at for 2027 and onward. Thank you.
Our next public commenter is Surya Ramakrishnan, followed by Susanna Pilkington. Surya, we've activated your microphone. Please unmute yourself and begin your comment.
Hi, just a quick question. I am part of Stryker Corporation. We just wanted to kind of clarify the use of the template as well that was posted by CARB. on the template, there seems to be many optional categories, which includes the dimensionalization of the greenhouse gases by gas type. So whenever it talks about assurance, in these assurance requirements, is the gas type something that we are looking to assure, because that's something that Stryker has not done yet. And then secondly, whenever it says optional or discretionary, is that something that in 2026 we are looking to do for the reporting period?
Hi, Surya. Thank you for your question. So for 2026 reporting, we are, pointing once again to the enforcement notice from 2024, requesting data that was being collected at that time. So if you weren't collecting data by gas at the time, you're not required to report it in 2026. We published that draft template as a helpful tool for companies to start organizing their greenhouse gas accounting and reporting systems, but it is not required for 2026 reporting. And in this proposed regulation for reporting that starts in 2027 and beyond, we are not proposing currently a template for reporting. There are required data fields, including reporting by gas, which is a requirement under the greenhouse gas protocol, and we are just sort of pointing to the protocol for that particular requirement.
The next public commenter is Susanna Pilkington, followed by Kevin Mireles. Susanna, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, thank you so much. Mirroring everyone else's comments of thank you. My name is Suzanne Pilkerton. I'm a senior consultant with Agendi with Samantha, who spoke a few minutes ago. A few questions for you. One, wanted to ask if you can clarify whether the proposed data exclusions mentioned in the presentation are meant to act as the de minimis that was mentioned in the prior workshop. Also would like to know if there are specific dates to watch out for both the 15-day public comment and the release of additional information expected in the fall. And finally, looking to see for companies who might need to submit recalculation data in the future, how would they submit this data? How many years is this applicable to? In alignment with the Greenhouse Gas Protocol and SBTI, recalculation typically applies to a base year as well as the most recent year, but not necessarily all years. I'm looking to see CARB's guidance here. Thank you.
So I think the first question was about materiality determinations and data exclusion. So in one of our slides we include some clarification on the greenhouse gas protocol allowance for certain excluding certain types of data in certain categories and activities within categories, as long as the sort of 5 reporting principles from the greenhouse gas protocol are met. So I would point you to that slide. For the 15-day package release, staff will announce the package when it's publicly available for public comment. The package will push back the reporting to November 10th in order to allow more time for reporting entities to submit their 2026 data. And then we'll also include clarifying edits that we'll sort of make available whenever that is released. Thank you.
Our next public commenter is Kevin Mireles, followed by Alex Piper. Kevin, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, this is Kevin Minelis, calling from Worldwide Flight Services and SATS. And the concern we have is that today, under the rules, our fiscal year ends end of March, so we are reporting on FY 25. So we're reporting data that's 18 months old. So it really goes out of cycle with where we're at. So we just published our FY 26, and we'd like to be able to align the reporting with the fiscal year. And once it's kind of a minor thing today, but once we move to assurance, if we have to provide assurance against FY 26, that again is going to be against 18-month-old data. And we're currently putting the processes in place to ensure that our data is of high enough quality, etc., so that we're ready for FY 27. But if the rules as currently applied mean we've got to get assured against FY 26, we're going to have to put significant effort to go and clean up and put in processes that's kind of too late, because we're having to go back in time, as opposed to if we're able to do it with the fiscal year more aligned to the fiscal year, so we're able to report FY 27 and FY 27. That's what we're really preparing for. So the question is can we submit FY 26 for this November, and will we be required to provide assurance on FY 26 if that is what's required in FY 26 for calendar year 27?
Hi, Kevin. Thank you for the questions. So I just want to clarify, we introduced that fiscal year delineation as kind of a flexibility for reporting entities to give people more time potentially to turn in their reports, but you are welcome to turn in reports based on a more recent data year than the one that you're technically allowed to turn in under the initial regulations. So I want to clarify that if you want to turn in the 2026 data, you are welcome to do that. And assurance is not required for 2026 reporting, but as we talked about in the slides, it is part of the 2027 and onward requirements. Thank you.
Our next public commenter is Alex Piper, followed by Marissa Dukovich. Alex, we have activated your mic. Please unmute yourself and begin your comment.
Hi there. Thank you for the time today. My name is Alex Piper. I'm the head of U.S. policy for Energy Tag. We are nonprofit advocates and experts in Scope 2 emissions accounting and disclosure, as well as clean electricity procurement. I understand CARB staff have decided to not recommend alignment with updated GHGP Scope 2 rules at this time. However, that update process is well underway and will likely be finalized by the end of 2027. And the changes to Greenhouse Gas Protocol Scope 2 guidance, as currently proposed, would reflect greater accuracy and impact for companies consuming large volumes of electricity by aligning Scope 2 emissions accounting with real-time and location matching of electricity generation and consumption. Those changes are in line with the purposes of this legislation, and we have recommended alignment between CARB requirements and those proposed updated Scope 2 rules. Alignment ensures greater impact for this policy and will reduce administrative burden and confusion for companies reporting under updated Greenhouse Gas Protocol Scope 2 rules in the future. And I understand there will not be dynamic regulations which automatically align with updated rules, but I do echo a previous question about clarity as to how CARB will or will not begin a future process to consider alignment with these updated Scope 2 rules. So I'm curious if you can provide just a little bit more clarity on what the thought process will be going forward, and can there be certainty as to whether or not or when a reevaluation for possible future alignment would occur? And thank you so much.
Hi, Alex. Thank you for your comments and questions. We really can't speculate at this time as to what a future reg amendment would be. We're really trying to get this initial regulation across the finish line and develop this, for 2027 reporting and onward. But I did want to echo what you said there. We cannot have a dynamic regulation that automatically incorporates updates to a protocol that's outside of CARB's board. And so, we will be incorporating by reference a version of the existing version of the Scope 2 guidance from the Greenhouse Gas Protocol because that's currently in effect. And we are looking to take this regulation to the board for consideration by the end of the year. Thank you.
The next public commenter is Marissa Dukovich, followed by Paul Ramey. Marissa, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, thank you for the meeting today. I just wanted to gain some clarity on adding the insurance companies into the regulation. And is that one, still up for debate and public comment? And two, what is the proposed timeline that would be implemented? And would assurance requirements follow? And then finally, as I believe it is still up for debate, when can we expect an update on if that will be going through or not? Thank you.
Hi, Marissa. So just to clarify, what we're proposing for this SB 253 regulation is to include companies in the business of insurance, include them in our emissions reporting requirements for 2027 and onward. As we mentioned, the 2026 context is unique. We talked about the December 2024 enforcement notice, which is in effect for first year 2026 reporting, as well as the existing kind of duplicative Scope 1 and 2 emissions reporting to the California Department of Insurance. But starting in 2027 and onward, this is what we're proposing for that future regulation. As far as the timing of a potential 15-day package, I believe another commenter asked about that. We can't give that update here at this time, but we're going to be announcing that package publicly when it's released, and it'll be open for a 15-day comment period, as well as posted on our website. Thank you.
Our next public commenter is Paul Ramey, followed by Audrey Bryn. Paul, we have activated your microphone. Please unmute yourself and begin your comment.
Thank you. Good morning. Paul Ramey on behalf of the Personal Insurance Federation of California. I want to thank CARB and the administration for including a regulatory approach that aligns 253 implementation with the California Department of Insurance's existing climate disclosure framework for insurers. For more than 15 years, insurers have reported climate-related information, including disclosure of Scope 1 and 2, and where appropriate, Scope 3 greenhouse gas emissions. Those disclosures continue to be publicly available on the California Department of Insurance website, where there is an online dashboard and historical overview. As CARB continues developing future regulations under SB 253 and related climate disclosure statutes, we encourage preservation of this coordinated regulatory approach and look forward to continued dialogue to ensure an efficient process. Aligning CARB's regulations with CDI's existing disclosure framework provides regulatory certainty, avoids duplicative reporting, and ensures insurers continue to provide comprehensive climate disclosures through the state agency the legislature has charged with regulating the insurance industry. Thank you for the opportunity to comment and look forward to continued discussion as this unfolds.
Thank you for your comment, Paul.
Thank you for your comment, Paul. Our next public commenter is Audrey Brain, followed by Mariana Ramirez Morales. Audrey, we have activated your microphone. Please unmute yourself and begin your comment.
Hi there, can you hear me? Perfect. So my name is Audrey. I'm a sustainability advisor at Bombardier. Thank you for holding the workshop. It's very helpful. So I understand that the requirements that were discussed in today's workshop will apply only for 2027 reporting and beyond. My question is for the reporting of 2026, should company disclose scope 1 and 2 as they currently disclose in their voluntary report, or do they need to conform with the proposed requirements, more specifically for biogenic emissions and emission reduction being reported separately from scope 1, 2, and 3, and with all the details required as discussed in today's workshop. Thank you.
Thank you for your comment, Audrey. So for 2026 reporting, we are pointing to the 2024 enforcement notice. So requesting that companies report data that they were collecting and then the form that they're collecting as of the December 2024 enforcement notice. So the requirements that we are proposing here for the 2027 and beyond regulation would not apply to the 2026 reporting. That is the requirements for that reporting are in the initial regulation that the board approved in February, and for the actual reporting is the requirements are in the 2024 enforcement notice. Thank you.
Thank you for your comment, Audrey. The next public commenter is Mariana Ramirez Morales, followed by Jonathan Ursillo. Mariana, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, can you hear me? Okay, perfect. Thanks. Thanks for your time and for the workshop. This is Mariana Ramirez from Sustainability Team at Globant, an IT services company. And I just have two questions. And number one is, since the company has global operations, do we need to report only California-related emissions or our global GHG emissions? And my second question is, how should the report be submitted? Will CARB provide a platform or portal for this? And also, if our integrated report of 2025 will be valid to comply for the 2026 reporting cycle, or do we need to prepare a different report? Thank you.
Hi, Mariana, for the first two questions there, and then I'll punt it to one of my colleagues for the last one because I missed it. The first question, do you report California or global emissions? You report global emissions. Just as per the statute, it applies to global emissions and operations. With regard to a platform for 2026 reporting, we're going to share additional guidance materials soon to support scope 1 and 2 emissions reporting. And in the slides, we had committed to putting that out by September 1st, 2026, in advance of the November 10th, 2026 reporting deadline. Looking to Pedro or someone else from my team with regard to the last question. I just missed it. Thank you.
I believe the last question was about whether the 2025 report for Mariana's company could be submitted for 2026, right? And so I think you would have to look back at your fiscal year and the sort of the cutoff of your fiscal year and the proposal, or not the proposal, the regulation that was adopted in February by the board in order to see if you need to sort of update the data or not. But in some cases, the 2025 data will suffice, depending on what sort of what period that captures.
Thank you for your comment, Mariana. Our next public commenter is Jonathan Ursillo, followed by Annabelle Klein. Jonathan, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, I'm Jonathan Ursillo from WAP Sustainability. Just had a comment on or a question on the assurance standards. So am I interpreting it correctly that it looks like the only assurance standard that would require um, additional accreditation requirements would be ISO 1464-3? And if I'm interpreting that correctly, any lean on what those accreditation requirements, those additional accreditation requirements would be?
Hi, Jonathan. I suggest following up with us directly to talk about some of the details there. I'd appreciate that. Thank you.
Okay.
Thank you for your comment, Jonathan. Our next public commenter is Annabelle Klein, followed by Graciana Mohabir. Annabelle, we have activated your microphone. Please unmute yourself and begin your comment.
Great, thank you so much. Hi, everyone. My name is Annabelle Klein, and I work in the position of Environmental Policy Counsel for the Government Affairs Division within the American Coatings Association, or ACA. ACA is a voluntary nonprofit trade association working to advance the needs of the paint and coatings industry and the professionals who work in it. The organization represents paint and coatings manufacturers, raw material suppliers, distributors, and technical professionals. As noted throughout this presentation, under Senate Bill 253, this law requires reporting entities to disclose their Scope 1 and Scope 2 greenhouse gas emissions beginning sometime in 2026. Again, as stated throughout this presentation, CARB has now pushed back that reporting deadline to November 10th, 2026. It is ACA's recommendation that CARB not enforce this November 10th, 2026 reporting deadline. Rather, it is the association's recommendation that the agency implement a reporting deadline of November 10th, 2027 for entities' overall greenhouse gas emissions reporting requirements. This recommendation stems from, among others, there being no final regulations in play, there being no additional guidance issued until September 1st, 2026, and the potential back-to-back burden of reporting fiscal year 2025 and fiscal year 2026 greenhouse gas emissions for entities. Thank you so much for your consideration of ACA's comments, and I look forward to working with the agency throughout this process.
Thank you for your comment, Annabelle. Our next public commenter is Graciana Mohabir, followed by Laura Mulry. Graciana, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, good morning. Christina Mo here with California Environmental Voters. First, I want to thank the CARB team for their hard work getting not only this workshop, but the proposed concepts together, and also the opportunity to provide comments today. I want to give some initial reactions to the concepts. First, I want to commend CARB for their prioritization of interoperability. We're also really glad to see the proposal for insurance company applicability. This exemption was concerning to us in the initial rulemaking, so, appreciate the direction that CARB is moving in. I also want to raise some concerns about the proposed path forward for Scope 3 reporting. Envirovoters and others had submitted a comment letter following the March workshop recommending option 1, broad applicability for all reporting entities to begin reporting on all Scope 3 categories starting in 2027. And this perspective that Envirovoters has is with the proposed phase-in, the category phase-in that we're seeing here, this could undermine the intent of the program and create even an unequal reporting obligation for covered entities. So for certain sectors whose Scope 3 emissions rest outside these identified top 5 categories, they're not really on the hook, whereas for others who are entirely captured here, they are facing a different obligation. Moreover, I want to echo the comments made by a series earlier. It's concerning that there is no date committing to when full Scope 3 reporting would be required. And I would love to hear from CARB on what this timeline or date for full Scope 3 reporting could look like. Thank you again.
Thank you for your comment, Gracina. Our next public commenter is Laura Mulry, followed by Joe Steyer. Laura, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, can you please clarify the insurance industry applicability? Do they need to submit anything for 2026? What exactly do they need to submit for 2027? If they're submitting to CDI, do they also have to submit something to CARB? And will you be changing the language in the regulation there? And then could you just clarify, so after 2027, will the categories of Scope 3 reporting increase in a phased way? Thank you.
Hi, Laura. Thank you for your questions. So the proposals here are for reporting requirements in 2027 and beyond. So they would not apply to 2026. It doesn't change the exemption that was included in that initial regulation. The requirements for reporting for insurance companies and all other entities that are in scope for this regulation is what we're proposing here and what we're hatching out, and there will be regulatory language and the staff report made available before our board hearing with an opportunity for feedback and public input. So thank you for your questions.
Thank you for your comment. Our next public commenter is Joe Steer, followed by Chip Horton. Joe, we have activated your microphone. Please unmute yourself and begin your comment.
Thank you. I just kind of have a couple questions and one comment. First, I just want to see, I know this year the reporting deadline is going to be November 10th. Are you guys considering keeping that reporting deadline November 10th for future years or moving that reporting deadline earlier? And along those lines, if you're going to keep such a late reporting deadline, are you considering moving the fiscal year time frame for what year will be reported under that year if we're having a later reporting date in future years? That's my first question. Also, I have some comments. It seems like these verification requirements, all of them will require some kind of significant cost, either for initial training or in the case of like the AA 1000, that you have to pay for each limited assurance, each assurance that's done through that association. And it seems like some of those standards are gearing more toward accounting firms and like engineering companies doing these verifications. I just kind of want to get a feel for where this is going, because a lot of entities that currently do like the mandatory greenhouse gas verification as well as LCFS verification may not be in position to do the scope-based verification, and just trying to get some additional thoughts on that. Thank you.
Hi, Joe. I can take your first couple of questions there regarding the reporting deadline. So November 10th, in the slides, we had said this is the new date that we're proposing for 2026. And we had also, at this time, proposing that to be the recurring reporting deadline for 2027 and onward. Open to feedback from stakeholders on that date. Lots of opportunities for more comments on that. And then with regard to the fiscal year timeframe, so you alluded to this February 1st cutoff that's in the initial regulation, and you were asking if we were thinking about moving that to a different time due to November 10th being the new reporting deadline for 2026. Feel free to suggest a new cutoff if you would like. If we leave it at February 1st, that does give a little more time and flexibility for reporting entities, which is a theme that we had heard before. But if you would like us to move that up and give a little less time to report, feel free to suggest that to us. And then I will pass it to Lynn from my team to address the assurance questions. Thank you.
Thank you for your question. On assurance, CARB has proposed a broad range of standards in order to meet the statutory requirements and also reduce duplication, which is required by statute. However, we have not finalized our approach on assurance, and so we're really interested in your feedback. Please submit written comment written comment. supporting your position. Thank you.
Thank you for your comment, Joe. Our next public commenter is Chip Borden, followed by Dixie Martino. Chip, we have activated your microphone. Please unmute yourself and begin your comment.
Good afternoon. Without trying to drill too deeply, there's a bit of regulatory uncertainty that was put in place by the withdrawal of the final package and an offer of new updates on September 1. That's only going to give us 70 days from September 1 to a filing deadline of November 10, which is a relatively short period of time. While we're very appreciative of the methodical and thoughtful way that CARB has gone through everything, the only comment I've heard today from anybody is that these would be, quote, in the nature of, quote, clarifying edits, unquote. Is there any more information or assurance or regulatory certainty you can share with us about what corporates need to be prepared for on September 1?
Hi, Chip. Thanks for the questions. Appreciate the desire to gain more clarity on what's going to be included in that 15-day package release. I can't give any more information on that right now besides what was in the public notice that we sent out on June 24th. But as we did say in that notice, the intent with pushing back the reporting deadline was to give more time for reporting entities and to give more certainty. And I think that pushing back that deadline does accomplish that, as opposed to August 10th, which was the prior deadline that we were proposing, which would have been a much tighter deadline. But stay tuned for an announcement, a public announcement with regard to the 15-day package.
Thank you for your comment, Chip. Our next public commenter is Dixie Martino, followed by Ben Roy John. Dixie, we have activated your microphone. Please unmute yourself and begin your comment.
Good morning. My name is Dixie Martino. I'm the Sustainability Manager for California Dairies Incorporated, a farmer-owned cooperative representing nearly 300 California dairy families. We support transparency and environmental stewardship. We continue to urge CARB to substantially revise the proposed SB 253 regulations before implementation and appreciate the opportunity to provide comment. As currently structured, the rule places significant burdens on agricultural cooperatives and family farms, while relying heavily on Scope 3 greenhouse gas accounting methodologies that remain highly uncertain and underdeveloped. Even the organizations responsible for these frameworks acknowledge major limitations in data quality, consistency, and accuracy. Reporting requirements built on immature methodologies risk producing unreliable emission inventories while exposing reporting entities to regulatory, legal, and reputational liability. The proposal also creates the potential for duplicate and overlapping accounting of the same agricultural emissions across multiple companies in the dairy supply chain, resulting in inflated emissions that do not accurately reflect real-world environmental performances. Additionally, compliance costs for new software, verification, consultants, and data collection will ultimately divert resources away from proven investments, including methane reduction projects, renewable energy initiatives, and other on-farm environmental improvements. Those costs will be borne by family farms and ultimately California consumers through higher food prices. We respectfully urge CARB to engage directly with agricultural stakeholders, consider an exemption for farmer-owned cooperatives, and develop a more practical science-based framework that prioritizes accuracy, feasibility, and meaningful emission reductions. Thank you for your time.
Thank you so much, Dixie, for this detailed feedback. We really appreciate it. I just want to share a couple initial responses and also encourage you to please attend our upcoming listening session focused on agriculture, food and beverage and related sectors. That'll definitely be a great place to share these comments and questions with us and engage in dialogue with peers across related businesses. I want to point to statute is very clear about Scope 3 reporting have penalties for non-filing only. And our team will prepare regulatory language and a staff report that provide some detail about how we propose implementing that statutory direction, but hopefully that offers you some reassurance. And second, I encourage you to take a look at the Scope 3 reporting requirements that we offered in this presentation. If you'd like to submit this feedback in a written comment to our climate disclosures email or participate in our listening session conversation, we're definitely interested in integrating your concerns and feedback into our proposal. Thanks so much.
Once again, thank you for your comment, Dixie. Our next public commenter is Ben Roy Chan, followed by Farid Kayali. Ben Roy, we have activated your microphone. Please unmute yourself and begin your comment.
Ben Roy, Senior Specialist with United Airlines. First, thank you for the time to overview the staff presentation and for this comment period to provide feedback. I wanted to comment and voice disagreement or just questions around the staff proposal to enforce disclosures broadly to the 5 most common Scope 3 categories, especially for applicability in industries that are atypical or unique. To support this viewpoint, U.S. airlines, through Airlines for America, have participated in a cross-company working session to determine against the Greenhouse Gas Protocol guidance that waste, business travel, and commuting were not determined to be significant based on the 7 criteria the GHGP defines, being size, influence, risk, stakeholder interest, outsourcing, sector-specific guidance, and other. For example, since airline emissions are so heavily dominated from jet fuel use, the size criteria dictates that only Category 3 for fuel and energy-related activities and Category 4 for upstream transport and distribution associated with our regional airline operations are sufficiently high. In addition, business travel emissions for other companies are typically mostly made up of air travel emissions. Since business travel is typically conducted on company-owned flights, these emissions are already captured within Scope 1 and thus would not be significant as a Scope 3 category for airline operations. United would like to advocate against a broad applicability rule on disclosing the 5 most common categories of Scope 3 emissions, since it loses nuance for specific or unique industries. We would like to advocate for CARB to allow a reasonable explanation of exclusions even on these 5 most common Scope 3 categories rather than enforcing broad applicability. Thank you.
Thank you for your comment, Ben Roy. I just want to clarify that staff's current proposal does include a data exclusions provision for the 5 most reported categories that we are proposing here, and then also a pathway for companies to report on the other 10 categories. So whichever ones are most relevant to your business, if you are already reporting it elsewhere, or if you are sort of undertaking the process to quantify those emissions, there is a pathway to also report those to us. Thank you.
Thank you for your comment. Our next public commenter is Farid Kayali, followed by Sue Yi. Farid, we have activated your microphone. Please unmute yourself and begin your comment.
Hey, thank you. It's Farid Kayali from California Bioenergy. Yeah, as California advances both corporate climate disclosure and the methane reduction initiative, how will CARB ensure that SB 253 framework, including Scope 3 reporting and biogenic emission accounting provision, are appropriately recognized and supports the role of a dairy digester, landfill gas project, and renewable natural gas in achieving the state climate objective, while on the same time maintaining consistency with existing California programs. To be more specific, for example, there's many dairy digester and landfill gas projects generate facility-specific methane measurement data and produce RNG with CARB certified life cycle carbon intensity values under LCFS program, for example. So what I'm saying here, it's nice to ensure that the reporting entities with various stakeholders on the dairy industry value chain are able to utilize this high quality project-specific data set where it's appropriate. and that the accounting framework provide consistent signal regarding the climate value of methane capture and utilizing investments. Also, I have one more question. I know you might kind of already answer it again, but just to ensure that I understand the previous question, for energy and transportation, like companies, some currently proposed. I run out of time, so that's fine. Yeah, thank you.
Hi, Marie. Thanks for that comment there about consistency with other CARB programs. Some of the other programs I think you're thinking about, such as maybe low carbon fuel standard or others, if they take a life cycle approach with the carbon intensities for biomethane, it's fundamentally different than the approach taken here. The greenhouse gas protocol focuses on, at least for biogenic fuels, is focusing on the end use of that fuel. And it, as we talked about earlier, would be reported separately from the scope 1, 2, or 3 categories. So that's what we're proposing to do with this approach here. Notice though in the slides we did not include any specific deliverability or matching periods or any specific requirements related to that. And what we are proposing here is that, essentially you could follow whatever protocol or program you're reporting to already for those biogenic fuels. And so if you have a matching period or deliverability requirement in another jurisdiction, you could follow that approach when you're reporting to us. Just let us know what you're following there. The greenhouse gas protocol basically says to follow the local jurisdiction's requirements. But we are not looking at life cycle negative carbon emissions or carbon intensities for biomethane. Thank you.
Thank you for your comment, Farid. Our next public commenter is Sue Yi, followed by Ella Stevens. Sue, we have activated your microphone. Please unmute yourself and begin your comment.
Hi. Do you hear me?
Yes.
Oh, okay. I've got two questions. For the 26 reporting cycle, I understand CARB is referring back to the 2024 enforcement letter, and also
Sorry to interrupt you. Can you please speak a little bit louder?
Yeah. So
thank you.
For 26 reporting cycle, I understand that CARB is referring back to 2024 enforcement letter, and also the minimum requirement is to disclose on the scope 1 and 2 emissions with no assurance requirements. But if a company has been disclosing more than the minimum requirement proposed by CARB, but is still willing to disclose on the minimum requirement, technically we're not then disclosing what we have been doing by the time of 2024 enforcement letter. Will companies be penalized for disclosing less than what they've been doing for 2024, or is it just accepted as like good faith for the cause? And also, I was wondering if the emission accounting methodology disclosure is required, even though the company has not been disclosing it by the time of the 2024 enforcement letter. Thank you.
Hi, Sue. If you have specific questions about this year's reporting for your particular company, feel free to reach out to us directly and let's work through those nuances offline. Thank you.
Thank you for your comment. Our next public commenter is Ella Stevens, followed by Mark Rose. Ella, we have activated your microphone. Please unmute yourself and begin your comment. Ella Stevens, are you there?
Hear me okay?
Yes.
Oh, wonderful. Good afternoon. My name is Elle Stevens, and I'm a climate risk attorney at the Environmental Defense Fund. EDF appreciates the opportunity to provide public comments and thanks CARB staff for their continued efforts to develop the SB 253 Climate Disclosure Program. We look forward to reviewing the continued developments of the concepts discussed during this workshop and providing additional written comments. Overall, we support CARB's approach to implementing this program, which is vital to provide transparent information and protect the investments and retirement of Californians. CARB's proposed approach provides flexibility during the initial reporting years while ensuring appropriate guardrails, transparency, and record keeping. Given the diversity of industries, operations, and supply chains covered by SB 253, reporting entities may benefit from the flexibility to use different emissions factors. That flexibility, however, should be accompanied with clear guardrails and minimum expectations for emission factor selection. Clear expectations will help ensure reported emissions are consistent, comparable, verifiable, and decision useful. On Scope 3 reporting, EDF encourages CARB to build on existing GHG protocol principles given the importance of Scope 3 emissions to companies' overall emissions impact. We encourage CARB to consider strengthening its proposal to more rapidly ensure reporting of at least 95% of Scope 3 emissions, which would align with emerging best practices while maintaining appropriate flexibility. If CARB allows any limited exclusions, companies should clearly disclose and justify them, and CARB should ensure they do not undermine the decision-making needs of investors. Finally, we appreciate CARB's recognition that implementation costs are likely to decline over time as reporting systems mature and companies gain experience. Strong Scope 3 reporting remains essential to fulfilling SB 253's statutory purpose by providing complete and decision-useful climate information. Thank you for your leadership on this important program.
Thank you for your comment, L. Stevens. Our next public commenter is Mark Ross, followed by Natasha Mescal. Mark, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, this is actually Sebastian DiClemente with International Motors on behalf of Mark Ross. A couple questions with very basic around with basic report of what format is expected for the report, whether the template is sufficient or a written report is required along with that. In addition to with the template, there that some cells call for free text, but that template validation does not allow for that. How do you advise proceeding? And just again, very basic to where do we finally submit this report? Thank you.
Hi, Mark. Thank you for your question. I just want to reiterate that the template that was published is not a mandatory template. And so we are, again, pointing to the 2024 enforcement notice for the requirements for reporting and just publish that template as a useful resource for companies to sort of organize their greenhouse gas accounting. We expect guidance on 2026 reporting, this sort of the intake procedures to be published by September 1st. So just you can be on the lookout for that for the sort of actual steps for submitting the data to us. Thank you.
Thank you for your comment, Mark. Our next public commenter is Natasha Mescal, followed by Richard Blostein. Natasha, we have activated your microphone. Please unmute yourself and begin your comment.
Good morning, Natasha Mescal with Ecotech, Environmental Compliance and Sustainability Consultant. I would like to suggest that in regards to next phase of reporting, 2027 reporting, that is the focus of this workshop, that CARB considers specifying which version of GWP values should be used for the purpose of consistency and comparability. And since this is the last step, just converting to CO2e, it shouldn't be hard to recalculate if previous reporting was using different version of GWP. May I ask why this was not considered? Thank you.
Hi, Natasha. Thank you for your question. We're allowing reporting entities to report using a GWP that they prefer or choose. And that should allow flexibility for companies reporting using different assessment reports, as we've heard from um, as we've heard from public feedback that companies may report using different assessment reports. CARB will publish these standards in the latest AR as well as in AR4 that is used at CARB, but we're seeking feedback. And so if you do have it seems like you may have some suggestions. We'd really encourage you to comment. Thank you so much.
Thank you for your comment. Our next public commenter is Richard Blasting, followed by Matt Pigoso. Richard, we have activated your microphone. Please unmute yourself and begin your comment.
Yes, thank you very much. My name is Rich Blaustein. I'm a reporter for the Continuing Education of the Bar's daily news platform. Thank you very much for this very informative webinar. I have a reiteration question about the insurance sector. So under what was talked about, Board Resolution 261 directed CARB staff to coordinate with the CDI, look at gaps in terms of reporting of insurance and greenhouse gas reporting. Could you just one more time reiterate what were some of the gaps discovered? What was the process? And then also, ultimately, will the insurance sector have reporting requirements for scope 1, 2, and 3 GHG emissions? Thank you.
Thanks, Richard. Appreciate you participating today. We do have a communication shop within CARB run by Lindsay Buckley, and happy to speak with you more via those channels. Thanks.
Thank you for your comment. Our next public commenter is Matt Picoso. Matt, we have activated your microphone. Please unmute yourself and begin your comment.
Hi, this is Matt Pigoso. I'm from ITW. I just had a question on the phase-in for the Scope 3 reporting and the categories that come first. Is there any materiality call there, or are you required to report all of the categories that are listed?
Hi, Matt. Thank you for the question. Yes, we are including a data exclusions provision in our proposals that would apply to the 5 categories for Scope 3 reporting. Thank you.
Thank you for your comment. Our next public commenter is Jonathan Kendrick, followed by Barnaby Lynch. Jonathan, we have activated your microphone. Please unmute yourself and begin your comment. Jonathan Kendrick. Okay, we'll skip Jonathan. We'll get back to it after Barnaby. Our next public commenter, Barnaby's gone now. And he's back. Our next public commenter is Barnaby Lynch. Barnaby, we have activated your microphone. Please unmute yourself and begin your comment.
Hi there, thanks for that. Barnaby Lynch from Watershed here. We're a technology platform. We help companies track and disclose carbon emissions. Thanks again, first of all, to everyone at CARB for all the work. Lots of very helpful detail here. Lots of very sensible decisions on rebaselining and reductions and data sources. So we really appreciate all the work that's gone on behind the scenes. One kind of concern to raise and then 2 questions for CARB. The concern is around the Scope 3 phase-in. I think the risk that we see in selecting those 5 categories to start is that it feels a little arbitrary and doesn't include some of the most material categories for where California's emissions are coming from. excluding capex and finance emissions, for example. And so we would echo the earlier points that we strongly believe that including all scope 3 is necessary to understand California's emissions. And if that's not the case, then clarity on when all of scope 3 should come in would be super helpful for corporates as they plan. And then on questions, two questions to start with. First, you mentioned that most of this guidance is for 2027 onwards. For baselining purposes, is year one 2026 data or is it 2027 data? Or do companies have any flexibility in choosing when they baseline, depending on their own kind of corporate needs? And the second question is around measurement uncertainty and would be helpful to just understand a little bit more detail around that and how companies should think about disclosing that. Should they rely on disclosed uncertainties by emission factor databases? What if those don't exist? What level of detail are you looking for around those? Thank you very much.
Thank you, Barnaby. So the baseline year will be the first year of reporting under our program. So it will be 2027 under this proposal, and then we put forward the proposal for uncertainty and certainly are accepting feedback on that. So please submit a public comment with your thoughts about how to handle this question. Thank you.
Thank you for your comment. Our next public commenter, back to Jonathan Kendrick. Jonathan, we have
Good
activated.
morning. Sorry, can you hear me now?
Yes, we can.
Fantastic. Good afternoon, John Kendrick on behalf of the California Chamber of Commerce. Really appreciate this workshop and staff's engagement, consideration of some issues, not just here, but also do believe that the extension to November 10th for the reporting deadline for 2026 was a positive change. Still have some significant concerns. One thing that we have consistently raised is a concern that some of the efforts by CARB appear to be trending towards a California specific standard. Have certainly heard today that that's not necessarily the intent. We're looking for flexibility. I did hear you say that the template for 2026 is optional. I just want to confirm that that will remain optional because if the template in future years is no longer optional, we are moving very specifically towards a California standard. The scope 3 proposal, appreciate that you're looking at phasing things in. Purchase goods and services is amongst the broadest and most data intensive, least mature scope 3 categories. Beginning mandatory reporting with that category may undermine the stated goal of easing compliance burdens. We think that entities should be allowed to report which scope 3 categories are most relevant and feasible for their operations, supported by a clear materiality and de minimis framework. We also think that on the data exclusion provisions, companies should not be required to calculate the emissions they're excluding merely to justify the exclusion. Reasonable good faith explanation should be sufficient where precise quantification is unavailable or would impose disproportionate cost. Again, we appreciate that CARB is looking towards preserving flexibility, and we urge you to continue down that path. Thank you.
Thank you for your comments, Jonathan.
Thank you for your comment, Jonathan. We have reached the end of the public comment queue. I'll pass things back to Emma Tomey for some closing reminders.
I'm sorry, Yvonne. I do see one more person in the queue, Smita Rajesh. Could we call on them? Yeah.
My apologies. Our next public commenter is Smita Rajesh. We have activated your microphone. Please unmute yourself and begin your comment.
Hi, am I audible to you? Thanks for the opportunity. My question is regarding the reporting period. Suppose if an organization has a fiscal year starting from April to March, but the sustainability reporting is for the calendar year. So can we still go ahead and submit the calendar year data as the latest that has been published, as well as unlimited assurance obtained? Is that possible?
Thank you for the question, Smita. So just clarifying once again that for 2026 reporting, we only expect you to submit to us data that you're collecting and in the form that you're collecting as of the 2024 enforcement notice. So I would just please ask you to sort of review that and submit the data that your entity was collecting at that point. Thank you.
Thank you.
Thank you for your comment. Our next public commenter is Stephen Grover. Stephen, we have activated your microphone. Please unmute yourself and begin your comment.
Oh, sorry. I was wondering, for your proposed assurance standards, you had mentioned that ISO 14064 requires additional accreditation requirements. I was wondering if you could clarify that.
Hi, thank you for your these are not additional as per se. The ISO family of standards are designed to work together. As we have also stated, IC 3410 and 3000 are also designed to work together. However, CARB has not finalized its approach on assurance, and so if there's something you'd like to bring to our attention, we'd really appreciate if you could submit written comment. Thank you so much.
Thank you for your comment. Our next public commenter is Sumer Shala. Sumer, we have activated your microphone. Please unmute yourself and begin your comment.
Yeah, hi, I'm Sumer. I'm with Breathe ESG, a carbon accounting and disclosure platform. I have one comment or question rather regarding the scope 3 bit. So the requirement 5 asks filers to report data and identify the method behind these kind of data that's actually being submitted. But while tracking at this at the line item level, isn't it feasible to expect category level data or supplier level granularity? And what kind of reporting standard format would you recommend, or is that something that will be published before or prior to the 2027 deadline as well?
Hi, Samir. Thank you for your question. I think your question skipped a little bit, so let me know if I didn't answer the question entirely. But I think the question is about whether there's a requirement to collect supplier level data. Under our proposal, we have a broad range of quantification methodologies that we are proposing to allow, including spend-based and activity-based accounting methods that can be done within a company's own accounting system that doesn't require data from suppliers. So this is, our proposal here is to align with the Greenhouse Gas Protocol in that way. So if you have specific concerns about that, please submit them as a public, as a written comment.
Thank you, everyone. We have reached the end of the public comment queue. I will pass things back to Emma for some closing reminders.
Thank you, Dr. Delgado. And thank you very much, everyone, for sharing your comments and questions this morning. We sincerely appreciate all your engagement with us. So I'll just share a few reminders in closing. Acknowledging the commenters who were seeking clarity for 2026 reporting expectations. As a reminder, our 2024 enforcement notice applies to this year's disclosures, meaning that CARB will accept emissions reports reflecting reporting and quantification approaches that were in effect as of December 2024 for your organization. We are revising the initial regulation to allow reporters more time to prepare their disclosures, submitting by November 10th. Use of the draft emissions reporting template released in 2025 is not required, and staff will share details on the 2026 report submission process by September 1st. We'll welcome your ongoing feedback on the topics presented today related to 2027 reporting proposals. We'll soon be opening registration for upcoming listening sessions held in August and September. And we'll be accepting any written comments to our climate disclosures email on an ongoing basis. There will also be a public comment docket open once the 15-day change is published with the 2026 updates, as well as a 45-day public comment docket for the proposed 2027 regulation. So please do sign up for our listserv if you have not already. That's how you'll hear as soon as these updates are published, including future public workshops and the listening session registration opportunity, as well as future public comment opportunities. And please reach out to us at climatedisclosures@arb.ca.gov if you have any follow-up comments or questions to today's workshop. Thanks again, everyone, and I hope you have a great rest of the day.